All right, if you're a business owner or a manager, you're going to want to pay close attention. The next few minutes could save you a lot of money. We're breaking down the huge changes to the corporate income tax law for 2025-2026, and we're focusing on exactly what you need to know to stay compliant and, more importantly, boost your bottom line.
Here's how we're going to tackle this. First, we'll get into the why behind this new law. Then, we'll look at the new rates and what that means for your savings. After that, and this is super important, we'll cover the new rules for deductions, the biggest tax traps you need to avoid, and finally, a quick checklist so you can ace any tax inspection. Sound good? Let's dive in. Okay, so first things first, why are we even talking about this? Why a new law? Well, this isn't just about the government shuffling numbers around. Nope. This is a really strategic move, and it's designed to hit some specific economic goals that are going to directly impact how you run your business. So, the government's got two main goals here. On one hand, they want to give a real leg up to small and medium-sized businesses, businesses just like yours, with some much-needed tax relief. But on the other hand, they're really cracking down on fraud and tightening the rules. You got to understand both sides of this coin, because it's key to managing your money and getting your expenses reported correctly. All right, let's get to the good stuff, the part that hits your bottom line directly, the new tax rates. Let's quantify this and see the real, actual savings you could be looking at. Okay, the biggest change here, the real game changer, is this new tiered system. Instead of one flat rate for everyone, the law now gives a break to smaller companies. Basically, if your turnover is 50 billion VND or less, you are going to see a direct benefit. It's as simple as that. Let's put some real numbers to this to see what I mean. Imagine an SME with a profit of 5 billion VND. Under the old rules, that flat 20% rate meant a tax bill of $1 billion. Ouch. But now, with the new 17% rate for their tier, that bill drops all the way down to 850 million. That is a significant saving. So here's the bottom line. That simple rate change isn't just a tiny tweak. For a business this size, it translates into a direct annual saving of 150 million VND. Think about that. That's real capital you can pour right back into growing your business. Now, saving money on the tax rate is awesome, but don't celebrate just yet. It's only half the battle. To really maximize those savings, you absolutely have to understand the new rules for what you can and what you can't deduct as a business expense. So let's dig into the core conditions. So what even is a deductible expense? Let's keep it simple. It's any cost the government says, okay, you can subtract this from your profits before we calculate your tax. The more you can legally deduct, the lower your taxable income, and you guessed it, the less tax you end up paying. Now, to qualify, every single expense, no exceptions, has to meet these three conditions. 1, it's got to be for the business. 2, you need a legit invoice. And 3, and this is the huge change you need to pay attention to, it has to meet a brand new payment rule. Okay, this right here is a massive operational change you just can't afford to miss. The threshold for mandatory non-cash payments, we're talking bank transfers, has plummeted from 20 million VND all the way down to just 5 million. This is going to affect so many of your day-to-day transactions. You really need to get this right. All right, so we know the rules. Now let's talk about the common mistakes, the traps that get so many businesses into hot water. Avoiding these is absolutely key to protecting your profits and preventing those nasty, painful penalties. This table lays it out perfectly. See? Pay a 4 million VND invoice in cash, you're good. It's deductible. But pay a 6 million VND invoice in cash and poof, that entire expense is disallowed. It's gone. The only way to deduct it is to make that payment through a bank transfer. It's a black and white rule now. You know, during a tax audit, there are two areas that get put under a microscope more than any other: salaries and marketing. For salaries to count, you need the whole package: contracts, payroll records, proof of payment. For marketing, same deal. You need a contract, reports proving the work was done, and acceptance forms. If you're missing any piece of that paper trail, auditors will throw those expenses right out. No questions asked. And then there's the most dangerous trap of all: using fake or blank invoices just to pump up your costs. Let me be clear. The consequences here go way beyond money. We're talking potential criminal charges. This is a red line you just do not cross. Ever. And while we're at it, keep an eye out for these other common slip-ups. Trying to deduct personal stuff like family trips, expenses without proper invoices, or even paying fines for traffic tickets, those are all automatic no's.
Same goes for messing up your asset depreciation or claiming way too much interest on loans, specifically anything over 30% of your EBITs.
And the cost of getting this wrong? It's huge. This isn't just pocket change. Just look at this example. If you have $7.5 billion in expenses disallowed, that could lead to a jaw-dropping $1.5 billion in back taxes you suddenly owe. And that's before they even start talking about fines.
Okay, so with all these risks, how do you make sure you're ready? How do you stay compliant and walk into a tax inspection feeling confident, not scared? Let's break down exactly what the auditors look for and how you can prepare your business starting today.
Tax authorities will almost always zoom in on these 5 areas.
Why?
It's simple, because this is where they historically find the most mistakes, the shakiest documentation, and yeah, sometimes even fraud. You need to treat these as your hotspots and make sure your records for them are absolutely bulletproof.
So let's do a quick self-check right now. First question for you and your team. Does every single dollar of revenue, every sale you make, have a perfectly matched, legal and correct invoice? I mean, every single one, no exceptions. Next up, have you already gone back and updated your company's payment process? Do you have a system in place that automatically flags any payment over 5 million VND and guarantees it's paid by bank transfer, never in cash? And last one, think about those high-risk expenses we talked about, marketing, consulting. Are those files truly audit-proof? If an auditor walked in tomorrow and asked for the records on one of those, could you immediately hand them a complete file with the contract, the performance report, and the acceptance record?
Look, it really all boils down to these 3 core principles. First, remember taxes on your profit, not just your revenue. Second, use the rules on eligible expenses to your advantage. It's how you legally lower your tax bill. And third, be obsessed with your documentation. Manage those costs diligently to avoid any inspection headaches.
So I'll leave you with this final practical question. Imagine this. Your business has a 6 million VND invoice. Your accountant comes to you and asks, should I just pay this in cash? What do you tell them? See, getting these details right isn't just about following the rules. It's about actively taking control of your company's financial health and its future. Thanks for watching.